Stop. Don't scroll past this. What I'm about to tell you in the next 20 minutes is going to completely change how you see the silver market. Something extraordinary may be happening in the silver market right now. For more than 15 years, one of the most powerful financial institutions in the world was widely believed to be betting against silver. But now, the data suggests something has changed. And if that shift is real, it could reshape the entire precious metals market. Because when a giant like JPMorgan Chase changes its strategy, the ripple effects can move markets across the globe. Today, we're breaking down why this 15-year shift matters, what the data from the Commodity Futures Trading Commission is revealing, and what it could mean for the future of silver prices. By the end of this video, you'll understand why many analysts believe the silver market could be entering a completely new phase. Let's start with the story behind this controversy. Welcome back to John Forecast, where we decode the macro forces behind the gold, silver, and global market moves. The silver market's most controversial player for years, discussions about the silver market always seem to circle back to one name, JPMorgan. Not just any bank, but the largest bank in the United States by assets, a financial powerhouse with enormous influence across global markets. And for more than a decade, many traders and analysts believed that JPMorgan held one of the largest short positions in the silver market. Now, before we go further, let's clarify what that actually means. What a short position really means. When an investor takes a short position, they are essentially making a bet that the price of an asset will fall. Here's how it works. You borrow an asset and sell it at the current market price. Later, if the price drops, you buy it back cheaper. The difference becomes your profit. Short selling is completely normal in financial markets. It happens every day across stocks, commodities, and currencies. But the controversy around JPMorgan wasn't simply that they were short silver, it was the size of the position. At certain points over the past 15 years, analysts believe JPMorgan controlled an enormous concentration of short contracts in the silver futures market. And when one institution controls a huge portion of a market, questions naturally start to arise. The manipulation controversy. Over the years, many traders accused major banks of manipulating precious metals markets. Investigations eventually led regulators to take action. In 2020, U.S. Department of Justice and the Commodity Futures Trading Commission charged traders at JPMorgan with engaging in a practice known as spoofing. Spoofing involves placing large orders to influence prices and then canceling them before they execute. The result? The bank agreed to pay roughly $920 million in fines related to manipulation across precious metals markets. That was one of the largest penalties ever issued in commodity market enforcement. But here's the important detail. Even after all that controversy, the bank still maintained major positioning in the silver market. Until recently. But wait, if JPMorgan had such a long history of being positioned against silver, why would they suddenly change course now? That's the question investors everywhere are trying to answer. The data that sparked the debate. Every week, the Commodity Futures Trading Commission publishes a report called the Commitment of Traders Report, often referred to as the COT report. This report shows how different groups of traders are positioned in futures markets. Categories include commercial institutions, hedge funds, large speculators, retail traders. Commercial institutions include large banks and major commodity companies. And in recent months, analysts noticed something interesting. The massive short positions historically held by commercial traders have been shrinking, gradually, quietly, but steadily. At the same time, long positions have been increasing. In other words, the institutions that were once heavily betting against silver appear to be reducing those bets. Some analysts believe they may even be positioning for higher prices. The physical silver market is tightening. To understand why institutions might change their outlook, you have to look beyond futures markets. The real story might be happening in the physical silver market. Unlike paper contracts, physical silver cannot be created with a keystroke. It must be mined, refined, and delivered. And recently, inventories at the COMEX have been trending lower. These inventories represent the metal available for delivery against futures contracts. When inventories decline while demand increases, it can create pressure on prices. And demand for silver is growing across multiple industries. The green energy revolution, one of the biggest drivers of future silver demand, is renewable energy. Solar panels require silver for their conductive properties. In fact, silver is the best electrical conductor on Earth. Every solar panel contains small amounts of the metal, but when you scale that across millions of installations worldwide, demand becomes enormous. Governments around the world are investing heavily in renewable energy infrastructure, and that trend could continue for decades. Electric vehicles and electronic solar energy is just one piece of the puzzle. Silver is also used in electric vehicles, semiconductor manufacturing, consumer electronics, medical equipment, power infrastructure. As global technology demand grows, silver's industrial importance continues to rise. That's one reason analysts often describe silver as having a dual role. It's both a precious metal like gold and an industrial commodity like copper. Here's something most investors don't realize. The entire global silver market is tiny compared to other financial markets. The gold market is larger, the stock market is vastly larger, and the global bond market dwarfs them all, which means something important. When large institutional capital begins flowing into silver, prices can move very quickly. The gold-silver ratio. Another factor analysts are watching closely is the gold-silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, the ratio has averaged around 60 to 1, but in recent years it has often climbed far above that level. When the ratio rises, it generally suggests that silver is undervalued relative to gold. Many investors view those moments as potential opportunities. If silver begins catching up to gold, prices could move significantly. Global demand trends. Demand growth isn't limited to Western markets. Asia plays a huge role in global silver consumption. China, for example, is one of the largest users of silver in manufacturing. Its solar energy expansion alone is massive. Meanwhile, investors in India have historically used silver as a store of wealth. And industrial demand across Asia continues to grow as technology production expands. Large institutions like JPMorgan operate globally. They see supply and demand trends developing across multiple continents. Sometimes, those insights appear in positioning changes before the broader market notices. Why institutional positioning matters. When retail investors buy silver, the impact on prices is usually small. But when institutions move billions of dollars into a market, the impact can be dramatic. Large banks employ teams of analysts, economists, and commodity specialists. Their research budgets alone can exceed what most individual investors could ever access. So when positioning changes appear in the data, many analysts pay close attention. It doesn't guarantee a specific price outcome, but it can signal that smart money sees a shift coming. Quick pause for a second. If you enjoy deep dives into gold, silver, oil, and global markets, make sure to subscribe to the channel. This channel focuses on explaining the real forces driving commodities and financial markets, especially how they affect investors here in the United States. Now, let's continue. What this could mean for silver prices. If institutional investors truly begin shifting toward long positions in silver, several things could happen. First, short covering itself can create buying pressure. When traders close short positions, they must buy contracts to exit those trades. That buying activity can push prices upward. Second, if institutions start building large long positions, they may actively support higher prices. That doesn't mean prices rise in a straight line. Silver is known for its volatility. It often moves faster than gold, both upward and downward. But the presence of institutional buyers can change the dynamics of a market. Silver's unique volatility. Silver has historically been one of the most volatile precious metals. It can rally dramatically during bull markets, but it can also experience sharp corrections. For example, in past cycles, silver has rallied more than 100% in short periods, then dropped 30% or more during corrections. That volatility can be both an opportunity and a risk. Investors who understand the market dynamics tend to approach silver with a long-term perspective. Investment approaches. Investors typically gain exposure to silver through 3 main approaches. Physical silver. That includes coins and bars stored privately. Many investors prefer this approach because it eliminates counterparty risk. Then there are ETFs like iShares Silver Trust. These funds track the price of silver and can be traded like stocks. Finally, there are silver mining companies. Mining stocks often move more dramatically than the metal itself because their profits are tied to commodity prices. Each approach has advantages and risks, and many experienced investors use a combination of all 3, the bigger macro picture. Silver's future also depends on broader economic conditions. Factors that tend to support precious metals include inflation concerns, currency weakness, geopolitical instability, rising industrial demand. When several of these forces align at the same time, commodity markets can experience powerful moves. And today's global economy contains several of those ingredients. So let's bring everything together. For more than 15 years, the silver market has been surrounded by controversy over large institutional short positions. Now, the data suggests those positions may be shifting. And whether that shift represents a full strategic reversal or simply risk management remains an open question. But one thing is clear. Silver is entering a period where supply, demand, and institutional positioning are all changing simultaneously. And when those forces align in commodity markets, major price moves can follow. For investors paying attention, understanding these dynamics could prove incredibly valuable in the years ahead. If you found this analysis useful, share the video with someone interested in precious metals or commodity investing. Let me know your thoughts in the comments. Do Do you think institutional investors are preparing for a major move in silver, or is the market overreacting? I read every comment, and your insights help shape future videos. Thanks for watching, stay informed, and I'll see you in the next one.